Okay, so let's kickstart today's session. All right, so for those of you guys who just joined us, we will be doing our price action trading masterclass for today. I have both the chat box activated. So if you guys have any questions, right, please just feel free to put them there. Okay, so just a quick introduction of myself. I'm Lee Sing. And you can reach out to me on LinkedIn as well. So if you guys have any questions on the sessions that were done on Wednesdays, Thursdays, or Fridays, if you want a recording of the session, right, you can actually go to vantagemarkets.com/webinars. Over there, we do have all the recordings of the previous sessions. So just a quick disclaimer before getting the session started, right? The information presented here, it's not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today, right? So first we will take a look at, or rather review, right, the multi-time frame analysis, taking a look at different market structures, right? So we covered this in quite of our few price action trading masterclass sessions. So I won't go into too much details on the theory, but rather we'll take a look at how we can apply them onto the different charts. So this would be the flow, right? And then following which I will cover more on supply and demand areas. So I'll first touch off a bit more on how we can cover supply demand zones, right? How we can take a look at order flow, understand them. Actually, it's tied in very closely with market structures. And then following which, right, how we can actually use these zones for our entry, stop losses, as well as take profit targets. So for this itself, right, there's actually two portions to it. One is just using purely price action, looking at specific zones, and then taking a look at market structure on your smaller time frame for confirmation. And then following that, if you want to combine what we have learned in earlier sessions, right? So for the whole of this February, for our educational series, we're actually covering on in-depth on how we can use Fibonacci extensions for both support resistance areas. So for this, you can actually combine the zones with Fibonacci extensions. And then we can also talk about risk and trade management concepts. So just to share a bit more personally, I cover, or rather I use anywhere between 0.5% to 1% risk per trade, right? So if those setups are considered a higher probability, maybe you want to risk slightly higher, whereas the ones that are maybe less probable, right, especially when your lower time frame entry is not in line with a higher time frame direction, then those you might want to consider risking slightly lesser. So generally, in terms of the percentage risk, right, I would say try not to go beyond 2% per trade. So that is my just sharing a bit more on like how I use this. So in terms of market structure, right, there are three types of market actually, right? So first would be your uptrend, which we saw, right, in our earlier sessions as well, where in this case, prices are forming higher highs and higher lows. And also we have our downtrend, right? So in a downtrend, it's successive lower lows and lower highs. And then of course, it'll be the ranging markets. So one thing to note about this, right, even though it looks very simple, looking at uptrend, downtrend, and ranging market, this can actually be very useful because with fractal nature of markets, right? So what this means is that any reversal that you see on your higher time frame, you will first see that happen on the smaller time frames. So we can actually use the smaller time frames as confirmation, right? So when there is a reversal on your bigger time frame, let's say if prices are coming into a daily zone, and we are anticipating that reversal, right? For price to actually acknowledge that daily zone, you need to first see, for example, a change in structure. So from bullish to bearish, right, in your on your 4 hours or even your 1 hour time frame. So then that gives you confirmation that there is a change in trend, right? And we can take the opposite direction. So instead of taking just immediate entries of that specific area. This is especially so on the higher time frames, because if you take a look at the daily zones or the weekly zones for that matter, right, you can see that they have a much wider range. So sometimes on your daily time frame, right, if it's a huge candle, if you're taking supply demand areas based on specific candles, you can see that sometimes these candles can be huge. So the range that they have within them, right? So let's take a look at this, right? So if you have one big candle, which you identify as supply demand, so usually for supply demand areas, right, I take a look at how these candles react. If there's a huge candle, especially with long wicks, right, then that for me is an area where there is a strong rejection. So take a look at this example, right, this bearish doji, or rather this move here. You can see that basically price pushed up, right, and then there's this sharp reversal. here before price actually continued much lower. So in this case, right, what this represents is that there are a lot of sellers coming in, right, to push price much lower. Okay, so in this case, when it's a huge range, especially on your higher time frames, right, if you're taking it off that specific zone, then in this case, right, this also means that you have a much further stop loss, right? So for example, within that specific zone, you're taking sells here coming into a supply area, and then also stop losses lying slightly above the zone. You can see that if you're using your daily time frame, in this case, right, each range can be maybe 50 pips or even more, right? So depending on the currency pair. So in this case, right, when you're on the smaller time frame, you can keep your stop losses much tighter. It can be maybe the same trade, right, but with a smaller stop loss. That can be a much higher risk to reward ratio. But of course, with that, right, there's also a higher risk of being stopped out, right? So that it's, yeah, you'll have to weigh in between, right? But that's the idea. So trying to find our higher time frames direction and using the smaller time frame entries as stop losses. Okay, so this it's on uptrend, downtrend. We also talk about ranging markets quite a bit previously, right? So on the concept of order flow, you can see that in ranging market, essentially it's one where you don't see a clear direction. Prices are moving sideways, right? So prices are respecting it as both a support resistance level. In this case, right, what we shared quite a bit on liquidity sweeps, right? So the idea that when price comes into these areas, right, these zones, there are many buyers and sellers lying at this area and with their stop losses lying slightly above. So in such cases, right, there are a lot of liquidity lying slightly above these zones. So I've covered this in our earlier sessions as well. So when people are buying, right, they will buy and put their stop losses, which are essentially sell orders slightly below, right? So there's a lot of sell side liquidity lying here, and then likewise for this area, right, buy side liquidity in terms of stop losses for your sells or buy stops. So for people who are playing breakouts, right, they want to play a break above, right? So some people would wait for a break and close before taking that pullback. But you can also place a buy stop if you're anticipating, huge maybe news data coming up that will push the price much higher. Then in this case, you might want to consider putting buy stops here. So in this case, what happens here is that there are a lot of liquidity lying above it. So before the strong push down, if you're a big player coming into the market, you want to ensure that there are opposite sides taking your direction. So in this case, if you're going to sell, right, you need people to buy. So all this buy side liquidity here, you can see price push slightly higher, tap into this area before going lower. So this spikes, right, can be what we consider liquidity sweeps. So in this area, right, if price to push much higher into this zone, you need basically strong buying power, right? Price pushing into this area before it comes, before it sells off. So in this case, right, there are buy orders that are being opened to push price into this zone, as well as sell orders, right? Sell orders would be in profit. Your buy orders would be in a loss. So when price comes back into these areas, right, they can serve as order books. Okay, so this is on ranging markets, right? So how we can actually use this, right, on the concept of order flow, it's basically if you're in a trending market, you can see that higher lows and higher highs, right? The idea here is that in a bullish market structure, right, price would continue, so you're in a bullish order flow, right? Whereas if it's bearish, right, then the likelihood is that price will continue in a downtrend until there is a change in market structure. When you're in a sideways market, right, so this is slightly different. So notice that in an uptrend, right, all your highs are being violated, whereas your lows are constantly holding. So they can serve as good stop losses because if price breaks below this zone, right, this is where we want to get out of the position. But if you are in a ranging market, right, you can see that both the highs and lows itself, they can be targets. Why? Because this idea is that in an uptrend, right, you see that the lows broke the last high. So the lows are not to be considered strong, right? So they're not violated. But if you're in a ranging market, you see that over here, right, the lows did not break the high. These areas are just being respected. So this lows itself then becomes a target. So it goes to and fro, right? And then again, when price comes into this zone, right, if you can see on your smaller time frame, demand areas are starting to hold, you're seeing that pullback, then what it tells us is that we can take a shorter term long position targeting this high because this high itself failed to break the low. And the reason why that we know that it fails to break the low is because on your smaller time frame, you're seeing that demand areas are starting to gain control. Okay, so even though this structure itself seems very simple, right, but this is actually useful in helping you to determine potentially the direction, right, and potential targets you can look at. Okay, so with that, let's take a look at a few examples, right? Let's take a look at euro dollar. Okay, so I'll just bring up the chart in a moment, right? And at the same time, if you guys have any questions, right, just feel free to put them in the tab. I just give it a while to load. So for some reason, today's very slow. My computer is really slow. Okay, let's see. Okay, let's just use this one instead. This is a bit easier. So in this case, right, let me just go on to the higher time frame first. Okay, so on euro dollar, right? Oh, sorry, this is actually on dollar CAD, it's not on euro dollar, but I guess it's the same, right? So let's just go on to the charts. So in this example, right, on dollar CAD, right? So let me start with the zones first, right? So to talk about zones itself, just remove this drawings. Okay, so for zones itself, right, supply demand areas, there are a few ways you can take a look at them, right? One is looking at just pure graphical levels. If you don't want to go into the deeper details on them, right, you can just take a look at just horizontal support resistance levels, essentially zones that price reacted off multiple times, right? And these zones itself can serve as interesting areas to watch, especially when price enter into these zones. So take a look at this example on dollar CAD. This is on a 4 hours time frame. You can see that prices tested the resistance, right? We saw that strong rejection of it once over here, and then again, right, the next one over here. And once price broke above this region, right, then it became a resistance turn support level. Right, so when price broke above this, then what happens is that price retested the zone as a support, right, before it continues much higher. So that's one way to look at it based on graphical levels, right? For me personally, I take a look at how price interact within each candle. So that would be a slightly more precise way of defining the zones, right? So if you want to take a look at it based on specific, entries, specific zones, right? That's another way to look at it, right? So of course, this is depending on your personal preference, right? So in this case, right, for me, I take a look at areas where there are long wicks, right? So long wicks before price actually reacted off these zones. So take a look at this example, right? Price did not actually come back to test it, right? But let's see here. No, actually, price came back to test it. So see this zone, right? So we have this huge wick here, this area, right? So there is a strong wick over here, long wicks, right? So what this tells you is that price tried to push higher, but this was met with resistance, right? You have sellers at a specific price that rejected, right? So you have either buyers taking profit at this area, or you have sellers coming in to push price lower, right? And this was represented by the wick. So price actually failed to close higher. There was a rejection here. So in this case, right, once we saw this for me would be the supply region. So you can see following which what happened, right? So following that wick, you can see that price came into the wick. So extend this to the left, to the right. You can see that price came in, it held below the wick before this bullish candle here, right? And this bullish candle has relatively small wicks compared to the body, right? If you compare the ratio of the length of the wicks to the body, you can see that this is a very strong bullish candle. Small, high, there's a big gap between this open and close price with relatively small wicks or relatively short wicks. So in this case, right, this for me is a bullish candle. It also shows that there's acknowledgement of this as a resistance before price pushed up much higher. So once that happens, right, this becomes a resistance turn support area, right? You can actually take the previous candle that's still held within the wick as the support, or you can just take the whole zone, right? So this one is depending on, which way. If you take it based on specific candles, you can see that it's much smaller, right? So the entries are much more narrow. So this area here, right? Whereas if you take it based on a specific zone, like this whole zone that we have, then you can see that it gives you a much wider zone to work with, a much wider area. So there are times where price actually come into this area, right? Just tap it slightly above before it continues much higher. So this is why, right, as much as possible, right, if you want to take it based on specific candles, right, there are lower chances of entry, especially if price did not actually spike into this candle here. But just for me itself, right, personally, I would just take it based on the last candle that held within the wick. Okay, so that's just my personal preference, right? So in this case, you can see that price came in, right, tap into this area. So if it comes into this zone, you're on a 4 hours time frame, right? If you want confirmation on your lower time frame, so let's just focus on this portion of the chart. Okay, so usually you can go down to either the 1 hour time frame, the 15-minute time frame. So depending on how low the time frame you want to go, right? The lower the time frame, the noisier it gets, or the choppier it gets. Okay, so in this case, you can see that this zone, right? If I'm on a 1 hour, you can see very clearly here there is this change in structure. Just zoom in. Okay, so you can see here, right? Just take a look at the most recent move down, right? So on the 1 hour, you don't see that much price movement or that much candles, but if you take a look at structure, right? So this whole leg. So at every pullback, right, given the smaller time frame, you can see that even though this is the bigger time frames pullback into a demand area, if you're on a 1 hour time frame or even a 15 minutes time frame, which I believe will be clearer, but in this case, because my com is a bit laggy, right? I'll just show the 1 hour for today, right? But if you go to the 15 minutes, you can see this as well. But if you switch it in close, you can see, right? So take a look at the most significant lows and highs. So you can see here, right? Prices are forming your lower lows, lower highs coming into this demand region. Okay, so notice the most recent highs and lows, right? On this leg that we have circled. So you have lower lows and lower highs coming into this region, right? So there are a few ways you can play this if you are a breakout trader, right? You're looking at a break above a resistance area. This is the last high. So you can see this zone here. Okay, so this is the last resistance area. You can see price came in test as both a support and resistance. You also have this area, right, where price formed lower lows, lower highs. But in the last move here, you can see that this move actually failed to break the low. You can see that price failed to break the low, right? It came into this low, and when it failed to break the low, right? So within this market itself, this is actually ranging. If you're on the smaller time frame, if you're on the 15 minutes or even the 5 minutes, you can see that this is ranging, moving sideways, right? Support testing it as both a resistance level. So recall in the ranging market that we covered earlier in the slides, right? If price comes into the demand area and demand starts gaining control, it shows you that this high itself, it's a potential target and it's in line with your higher time frame order flow because you are currently sitting on the demand region here, this pink box that we have. Okay, so this is one way, right? Another way would be to wait for price to enter into this zone, right? Or to wait for a break of the last high. So this is actually the last high. Right, so if you're playing a range, right, would be to go down to your either the 5 minutes or even smaller to wait for a break above this area, right? Or if not, right, you will want to wait for a break above the last high. So this, in this case, you can see that this is actually the last high that broke the previous structure, right? So this can be in the form of a buy stop or a breakout and a pullback. But in this example, right, price would have missed this entry. So this for me would have been the area or the zone to watch for a break and a pullback, right, before playing a long position now. So in this case, right, this entry wouldn't have been entered, right? But the idea is just to understand that you can see that across different time frames, right, this concept of market structures, right, applying supply demand areas on these different time frames also work, right? You can actually use them to help you to determine whether the zone is going to hold, because there's always a case where price could just continue like this. So going to form lower low, lower high, and completely break this zone. Okay, so this it's an example on dollar CAD, right? Let's take a look at other examples. So we covered on demand, right? Let's try and see if we can find a supply area. And let's see if the same logic applies. Okay, so let's say if you're in a supply area, right? So if you're looking for supply in a downtrend first, right? So picture of lower lows and lower highs. So in this case, right, let's take a look at this move. Okay, so you can see again, right? So zoom here. This area, right? So long wicks and then a huge rejection below. And usually the rejection should be confirmed with bullish or bearish candle, right? If you're in the downtrend, then you want bearish candle confirmation. So you can see here, right? Once again, we have this. So focus on this portion of the chart. This box. So we have the first one, which is basically this wicks, right? So long wicks that we have over here. Price holding within the wicks, just this area. and then following which a break below, right? So this is demand on the smaller time frame, right? So essentially this is just demand area, price breaking below, and this break is characterized by the strong bearish candle. So it shows that there's strong selling pressure coming in, and this candle itself has again very short wicks compared to the body. Okay, so once that is done, right? So when supply or when demand fails, right, create supply and vice versa. So what is the last candle that held within this wick? You can see that the last candle that held within this wick here, this is the wick, right? So what's the last candle that held within? It's actually this candle. So this area here. Okay, so this is the supply region. So you can see that when you extend it across, right, this area, right, this is the zone. So again, right, you can take it covering the highs. This is one. You can also take it covering just that specific candle. Okay, so again, this is personal preference, right? For me, because this is the whole high, so I'll just cover the whole zone, which is the supply, right? But either one would work, right? So in this case, you can see again, right? So in price pushed up into this area, but again, right, we're not taking immediate move from here because this move up is actually very bullish. At the same time, right, when it's a bullish move, you can see that if you're on your smaller time frame, so this whole move up into the supply region, this whole area up, right? So if I were to just put this with a marker, right? Let's take a look at a smaller time frame. Okay, so let's go to, in this case, I'll just go to the 15 minutes. Right, let's see if it loads as fast. Okay, that's not too bad. Okay, so let's see where it is. Okay, so okay, I'll just switch it to the 1 hour because it's loading really slowly. Okay, there we go. Okay, so in this case, you can see again, right, on the 1 hour time frame, right? So of course, on your smaller time frame, you get a clearer picture, but that's the idea, right? So in this case, when price comes into this zone, you can see here, right, this area. Again, you have higher lows, higher highs, right? If I were to switch it in close, you can see the same thing as well, right? Clear highs and clear lows. So take a look at the peaks and the troughs of this most recent move up, right? You clear higher lows, higher highs, moving up here, right? What's the last low that broke the high? You can see this region. So this area, you can see that this is the last low, right? This is the last low that we have. This zone here, it broke the high, right? So this is the area, right, that you want to wait for. So you want to wait for price to break below this region. Once there's a break below, right, you can play a breakout pullback, right? If you want to wait for a retest of this zone, or you can put a sell stop. So either one, right? But basically on the 1 hour time frame, right, this is the last high that broke the previous high. So for me, this is the area to watch. I will not consider this move because this is basically just one candle, right? It's just more of a slight hesitation. But in this zone itself, you can see that again, right? How this market structures can be applied across different time frames. So the logic is very simple, right? Looking at higher lows, higher highs, coming into this zone. If price did acknowledge this zone, then there is a change in structure, or there's a break of the last low, right? Before price continue to the downside. And even let's say without this example, right? So we might not have caught this one because prices continue all the way down. And if you're not looking at a breakout pullback here, right? Then below the zone, there wouldn't be any. But even this area itself, right? You can see this zone. Let me just push through with this. So this area you can see again, right? If I were to switch it in close. So you can see higher lows, higher highs, clear higher lows and higher highs. And then there's a break of the low here. The last low. So price broke above this low, pulled back. You can see here. Right, so this is when you can also use a Fibonacci retracements extension. So there is this low. If I were to draw a horizontal line across, you can see price pushed up and form a new high, right? And then it tested this low, and following which price broke and closed below the low. It also broke and closed below the support region, right? It was a previous resistance and support level. And then it actually pulled back to, I believe this is the 78.6 retracement. So if you take a Fibonacci retracement, right? So for those of you guys who are using Fibonacci retracement, you can take a retracement of this move actually from high to low, right? And it pulled back to the 78.6. So when we covered on Fibonacci retracement in January session, right, we actually covered on two things, right? One would be entry. So personally, entries for me would be 61 or 78.6, take profits at negative 27. So in this example, you can see that when you take a look at this retracement levels, right? So if I were to take a look at this retracement, Let's wait for it to get these levels out. Okay, so we have a 78.6, 61.8, right? So these are the two levels. 50% is where you can take a look at this premium discount zones. Negative 27 is the take profit target. Negative 68 is also a second take profit target. So in this case, right, as with the sessions that we went through earlier, right? So 78.6, 61.8, they are good entries, especially if it's in line with a higher time frame. So if there's a break in structure, prices are coming off this resistance area, right? There's a break of the last low. You can see that price coming into the 61 or 78.6 can serve as the entry, negative 27 as the target. So you can see that the most immediate entry, right? Price actually came in, spiked to the 78.6 here, this high. And then after that, push down and tap right at the negative 27. You can see this spike down. Okay, before it actually continued. One more tap and before it continued to the downside. Okay, so for me, I'm not sure why, but this negative 27 seems to be very useful. Okay, so this is another way, especially if you're taking a look at just retracement levels, zigzag pattern. But again, with this, right, again, our first confirmation, it's on bearish market structure, which you can see here, right? So price broke below the support area before we do any of this. Okay, so I hope that this is clear, like in terms of how we can look at structure, supply demand areas, and how we can actually combine all of these concepts together, right? So I know for retracements and extensions personally, right, I use it to support the analysis, but market structures is the main one in terms of looking at direction, right? You can see that at almost every interval, there will be a level, right? So in this case, right, this is used more for confirmation rather than taking it off like based on specific, just 50% and taking every entry off that level. Right? I try and look for higher time frame zones, right? So if there are any specific zones that prices are currently on, and if it's in line with your higher time frames direction. So in this example, right, if you're in a supply region, you want to look for opportunities to sell, right? Whereas if you're in a demand, right, you're looking at shorter term time frames opportunities to buy. Okay, so that's what we have for today's session, right? So I hope that this is clear. Yeah. So in this case, right, we talk about market structures, right? So we've went through it quite a few times on order flow, understanding concepts of strong highs, lows, right? Weak highs and lows, looking at uptrend, downtrend, sideways, right? So taking a look at or using these market structures to help you in your analysis. We also take a look at supply demand areas, right? So for me personally, I take a look at long wicks and following that interaction of the long wicks, right? I look for confirmation. This can be in forms of bullish candles, right? Or bearish candles. So if you're in a supply area, you want to wait for a strong bullish breakout and then vice versa. So we saw the example on dollar CAD. And then of course, right, risk management wise, personally, I do anywhere between 0.5 to 1% risk, right? So try not to do anything beyond 2%. Right, so it's always important to manage your risk, and in this journey itself, right, stop losses, it's normal. So just make sure that you manage your risk and don't over risk or over leverage on one trade. Okay, so yeah, if you guys have any questions, right, feel free to put them under the chat. Okay, if not, right, that's all that we have for today's session. Okay, so I see that we have no other questions. Okay, so if we have no other questions, right, that's all that we have for today's session, right? So I hope that this session is helpful, right? Do hop onto the charts, right? Try and practice this concepts, right? And yeah, so with that, we've come to the end of the session, right? So for next week, we will be doing a new series, right? In March for educational series. You can also sign up for Vantage at vantagemarkets.com/webinars. Okay, so thanks everyone, right, for staying with us till the end as always, right? Have a great weekend. Thank you, and we'll catch you guys again next week.